you. You know,
Right,
Marty, when you and
cheers.
I were talking, I was telling you about the U.S. Open, which was right in our neighborhood here down in L.A. And boy, what an amazing event! So, for those of you that got to go to the U.S. Open, I went on the Thursday. It was fabulous. They did a great job, and it was held at the L.A. Country Club. And there was actually an area at the U.S. Open for one of the family office groups here in Southern California. They took over a very large area. So I was a little jealous that I didn't get invited, but you can see that the U.S. Open brings out the best.
Fantastic.
Marty, can you hear me?
Yes.
Yeah, I got you.
Oh, hey Ken, how are you?
I'm good, thanks. Oh,
And I
okay.
can hear you
I'm a
great.
little lonely up here today. I can't see the screen, so I have no
That's
idea who's
okay.
with me. Thank you
That's
for
fine. So
waving.
you've got
Okay.
myself and
That's good.
Okay. Did you want me to
so
start? Was that?
No mask.
is that okay
Oh,
to
okay.
go ahead? All right. Ken, I'm going to introduce you and I'll introduce Kamil. So my name is Matthew Kessler. I'm a managing director at Case Equity here in Los Angeles. With us today, obviously, is Ken Knightsburg, Chairman and CEO of Devon Self Storage. So, for the past 35 years, Ken has been managing and running his business. And I think what we're going to learn today about Ken and the self storage business, and really just why it's so perfect for the family office, is that it just has unlimited capacity in terms of capital and demand from family offices and institutions. So, we do know that this has been an amazing asset class, whether pre-COVID, COVID, and coming out. Ken's company, and I'll let him talk about it after me, has 103 self-storage facilities with a market value of about $1.5 billion. Currently, there's 18 new facilities under construction. They have across the country. Devon has 27 states where you'll find facilities, 250 employees, and what's interesting, only 15 in the corporate world, and currently about 7 million square feet of rentable space. And they have about 39,000 tenants. Now, that should tell you a lot about somebody that understands the market, understands the city, understands logistics, has a really good handle on what's taking place with people moving and coming and going from a specific location, and really understanding if the MSA for in a particular area is going strong. So I know we're all excited, obviously, to hear from Ken. Our other speaker is Global Realty Capital, New York City, Dubai. Kamil Homsi is the CEO. He is a family office operating in New York and Dubai. And what's interesting about his areas, they concentrate on commercial real estate and alternative investments in an area that is very important to me at CPACE, which is renewable energy, fintech, and prop tech. So I think we're going to hear a lot of interesting ideas coming out of both, Ken and Kamil. For CPACE. CPACE stands for Commercial Property Assessed Clean Energy. At CPACE, it's a financing tool. We look at it as gap financing. We will help every type of, real estate aficionado out there in terms of efficiency, renewable energy, water efficiency, resiliency, stormwater management. Our job is to go into the capital structure and be that part of financing that is so difficult to find. Up to 20 to 30% of a capital structure is where PACE equity comes in. We provide 100% fixed rate financing. It's non-recourse. We'll do hard costs, soft costs. And what's nice is the terms are, 20 to 30 years. So if you as a family office or somebody that's in the real estate area or in cold storage, construction, development, engineering, and you're looking again for a really good participant to help you in your capital structure, that's what PACE equity does. So, I'll be able to talk a little bit about that type of efficiency as we go forward. So, Camille, I'm going to start with you, if that's okay, if you can hear me okay.
I hear you just
Fantastic. I'm
fine.
getting a wave of the hand. So I know that, you and I have been talking a lot about, your area and your area of discipline. Why don't you reintroduce yourself and tell us a little bit more about, Global Realty Capital and why you invest in so many different areas of the world.
Well, you hear me well, Matthew?
Yes, just speak up a little louder would be great.
That will be my pleasure. Good afternoon, everyone. I am sitting in New York at the office, and GRC Investment Group, we are a single family office originated in Dubai. Global Realty Capital is our onshore corporation in the United States. We are global investors with a mandate on alternatives. We do not invest in stocks and bonds. We focus on commercial real estate, on renewable energy, as you heard from Matthew, on waste management, and also on a few smaller buckets in medical device, in cybersecurity, and also we invest in patents. Excuse me, we are strictly LPs in our investments. Commercial real estate for me is 3 meals a day, 365 days a year. So I'm happy to be here. I know that Matthew always has a myriad of questions that cover everything that we know and uncover our experiences. Happy to join you all and looking forward to hear from everyone else. I'm also going to ask Ken if Greg Mackey still work with you.
He does. I haven't spoken to him in about 45 minutes.
Give him my best
How do you know
regards,
Greg?
We'll
How do you know
talk later.
Greg?
We'll talk
Okay,
later.
you got a deal. Okay, Greg's
we
my
met-
number 2.
We met, I think, in 2004, 2005, something like this.
So, Kamil, let me ask you a question. Talk
I've
to us
knocked
a
on a
little
lot
bit
of doors
about
here.
what's going on with sovereign wealth funds, their appetite for investing in the United States, and also talk about family offices coming out of the Middle East, investing in the United States, and what are they looking at?
Should I answer you this now or wait for Ken to introduce
No,
himself?
go right ahead.
Right ahead.
This question's at you.
Sovereign wealth funds are dictated by the geopolitics of the world. Where they stand today, their position from the United States and its allies in Europe, and what is going on of a conflict in Central Europe. So their investment, they're holding back, and their investments in different countries is always dictated by the directive from their own respective governments. Let's put it this way. The appetite for the United States did not change, but it is right now more conservative. You will find more activity from our side, which is the private high net worth, and also from the sizable allocations that we are doing due to the fact that today the United States among the industrial world is the only standing destination in not only in commercial real estate, but also in innovation, in fintech, in medical, in life science and other fields.
And when you talk about the sovereign wealth funds or family offices coming out of the Middle East or those that are based here like yourself, is there one or two asset classes that is the go-to for these investors over the last 2 to 3 years?
Being a patient capital and long hold, I haven't been attracted to multifamily since 2014. And I know many of my American friends, they shrug their shoulders. They say, Kamil, you don't care for multifamily. Our portfolio currently for several years has been comprised of industrial, of life science research centers, and of data centers, definitely of self-storage, and sporadically and on a deal by deal on student housing and also on senior housing. Those are my favorite. Those are my favorite property type, because like I said, we are looking, we don't want to get involved into the domestic regulations of different states on how the tenant-landlord relationship, and also on many other factors that are involved in that investment. Final thought, it is saturated with too many people bidding. I don't trust the experience of many of them. So I like to do what I find that is a long-term.
Got it. Well, I'll come back to you on life science, and I'll come back to you on industrial, because I'm interested to hear what other family offices are doing. Ken, welcome. Thank you for making the pilgrimage down to K&L Gates. And I also want to thank K&L Gates to hosting, obviously, Marty and IvyFON today. So, Ken, tell us a little bit more about, obviously, Devon Self Storage, above and beyond your introduction. Then I have a couple questions for you.
Okay. Thanks, Matthew. Good to be here again. It seems I'm here just not too long ago, right, Marty?
You were here back in January.
Oh, time flies when you're having fun, right? To pick up on what Matthew said, I'm the founder and CEO of Devon Self Storage. We're based out of Emeryville, California, across the bridge, and there was luckily no traffic. I made it here in no time. We currently operate 103 facilities in 25 states. We have about 44,000 tenants, all on 30-day rental agreements. It's a lot different business than the office or retail or even residential. 279 employees as of last Friday. That changes frequently. What else can I tell you? The business itself has been very, very good. We've been doing it for 30 plus years. The pandemic was probably the best 2.5 years our industry has ever seen, squared and then squared again. When the pandemic first hit in March of, what was it? I forget now, 20 or 21? 21. 20. I thought Chicken Little was an optimist. We were going to be in a lot of trouble. But very quickly, we saw something totally different as people were leaving the offices and working out of home, and it was the extra bedroom that they used to have all their valuable junk in, stuff in, excuse me. And they had to move it into storage so they could turn that into an office. And the whole industry went pretty much crazy. We saw occupancies we've never seen, rental rate increases of 15 to 20% a year. And it was just a wonderful, wonderful time. That's behind us now. We're back to more normal circumstances, but the business is still very, very strong. The Self Storage Association, which is the national not-for-profit trade group for the industry, commissions a study every 2 years. And back in 2006, the first year they did that, it said that seven out of every 100 Americans was currently renting a self-storage unit, man, woman, and child. But that 100% of the population knew what a storage facility was because you used to drive by and see the roll-up orange doors, courtesy of Public Storage. Today, that number is up to 11%. And plus, we've gone up from maybe 300 million people to 340 million. So the demand curve keeps growing. One of the things that the industry was very nervous about was that, I forget what you call them, not millennials, but the Gen Xers, the 20 to 30-year-olds, okay? I have underwear older than that. But that's the area that we thought we'd never rent to because they're all living in their parents' extra bedroom with their 70-inch screen TV and paying no rent. That didn't happen. They are renting like crazy and finding out that it's a pretty nice place to put your extra stuff, especially when in San Francisco, there's 6 of them living in a 2-bedroom apartment because it costs $4,000 a month. So we thought we wouldn't pick up that generation until they became like those ads you see on TV for one of the insurance companies. I forget where last thing you want to do is become your parents. They are a lot earlier than we thought. So there's a huge market out there still. If you take 340 million people, give or take, depending on whose census you want to believe, and we've only penetrated 11% of them, there's a little headroom there still.
Ken, let me interrupt and ask you a question. Sure. Let me just sort of direct this a little bit. You and I are both aware that there's just basically unlimited capital opportunity coming into the self-storage space. Where is it coming from, and why has it been so aggressive in the last 3 years?
Well, there's a couple of reasons. I'll take your second part of your question first. The reason that it's been coming in such spades is if you take a look at and if you use the NAREIT numbers, and I don't like to do that because anytime you put real estate into a daily tradable asset, you destroy some of its inherent characteristics. But nonetheless, that's the best measuring stick. If you look, and there's probably 30 different classifications in NAREIT of different property types, and you look at any 5, 10, 15, or 20-year period, every single time, either number 1 or number 2 is self-storage. And I heard someone in the previous panel talk about being recession resistant. That was the old joke about storage or recession proof. Nothing that I know of except maybe beer is recession proof. We are recession resistant. In good times, we do well, but we don't knock it out of the park. And in bad times, we do okay. So if you buy something for $1, be it a piece of real estate or a stock, and it goes down to 50 cents, you need 100% gain to get back to even. So in good times, we'll go from that $1 to $1.10, and in bad times, we'll go to 95 cents. We only have to make up 5 cents. So that's why over time, if you string a few years together, like my astute panelist here said, if you're a longer term investor, nothing has ever beaten us. Nothing. We don't have these wild swings like, the thing I'm most thankful for today is 35 years ago, we were in the office business. I'm sure glad we got rid of all those. Okay. Your first question, where's the money coming from? Well, we've always been kind of a bastard stepchild. We weren't institutional quality. Go tell that to Blackstone and KKR today, which have both opened up self-storage divisions. Everybody looks at the numbers and we're doing really well. So we've had your question there?
Yeah, by the way, I am a huge fan of self-storage. The one thing that people need to understand is that people are fundamentally hoarders.
I love it. Thank you.
Oftentimes I drive by one of these facilities, you see first month's free. Once they get in the hook, they're there for many, many years. The last thing I'll say is there's no tenant improvements. Office buildings, when a tenant leaves, you got to put in $40, $50, $60, $80 a square foot on a 5-year lease. That payment is not very good. So.
No, that's some of the beautiful things. If you look at, I don't want to monopolize the conversation, Matthew, but if you look at what I call the 4 basic food groups of real estate, all of which I've been in a previous life, office, industrial, multifamily, and retail, it typically, and when you use averages, you usually get in trouble, but I'll do it anyway. It typically takes about 65% occupancy at so-called street or posted rent rates to just cover the fixed nut of operating that asset as a business. On-site salaries, taxes, insurance, utilities, landscaping, janitorial, whatever it is. If you add historical debt of about 60, 65%, and obviously interest rates can make a difference, but you add about another 25 basis points. So now you need 90% occupancy before there's one dime of free cash flow as a current return on the equity, which is why when you see packages from brokers selling those kind of assets, they're always projecting 97, 98, 100% occupancy out forever. I'm in a 16-story office building across the bay. It's about 60% empty. There's no problem finding a parking place in the garage. If you look at storage now, it takes about 40% to cover the operating nut. One of the things you talked about, there's no TIs when a tenant moves out. You go in there with the broom, you sweep it out. You got 3 metal walls, a metal roll-up door, wire mesh top, and concrete floor, no utilities. Sweep it out and re-rent it. No broker's commissions, no TIs. If you add the same debt of 25 basis points, because the debt doesn't know what it's on, you're at 65% before you hit cash flow break even after debt service. So if you can get to 85%, you're printing money. If you can get to 90, that's better. If you get much above 90, what that tells me is you're not managing it very well because you're going to have normal turnover. Yes, ma'am.
Let me just sort of switch gears on you real quick. I know we're going to come back to you in that question from the gentleman in the audience, but Kamil, question for you. I know that the Raleigh-Durham Chapel Hill area of North Carolina is also called obviously the Research Triangle because it's proximity to the universities. Talk about the hub of technology. Talk about, the hub of biotech. And why is it that not only your own family office, but what I'm really looking for is why are other family offices so attracted to that area?
Well, definitely, Matthew, thank you for the question. Definitely, the society has been becoming more and more aware of health and also the need to improve our lifestyle. And then all that has been further accentuated during COVID, where people found the importance for this. For me, again, as a patient and long hold capital, I find that the future is for the next 10 years or for the future beyond me, after I give the baton to my successors, healthcare is not going anywhere. Actually, there will be more and more need, not only for pharma, for biopharma, and also for medical device and research into the diseases, but also as the medical community is also growing and going in that direction. So the next thing is that the tenants in those life science centers, they invest a lot. If it is TI or it is their own money, so they are rollover tenants. So that's for the benefit of the landlord operating and also when it is time for refinancing. Most of those assets are in excess of 100,000 square feet. And you don't only have medical over there, you have also other related services that like to be in those buildings because they find that this is the environment where they are finding their clients and also growing their business with knowledge, but also in growth. the Triangle is one of 3 main locations in the United States. Definitely Boston, definitely San Francisco, and New York is inheriting now that the office space in New York is more available and at a discount until we see what the future of those assets. They're like in Manhattan, where I am right now sitting, I see a lot of life science and research companies are moving into this area. So, and then the government of the city of New York is encouraging the same. Before I leave, I like to also ask if Ken remember the time when regional banks, community banks, and the credit unions did not know how to underwrite a self-storage. Give me a show of hands, Ken. I'm going back to the early 2000s where we were doing deals on self-storage and first and second generation at the time, meaning beginning of the climate control asset coming to market. Many banks did not know how to underwrite them. So we had to help their underwriters taking that deal to closing.
So, Kamil, let me go back to life sciences for family offices that are listening today and in the room. What's one or two, type of life sciences? You don't have to tell us the name unless you want to. In that triangle down in Raleigh, Durham, that you've invested in, and how well have they done? Because that's an area that I know family offices are so interested in, is life science.
Look, the barrier to entry is fairly high because of it requires knowledge and orientation for a lot of families. I am asked the same question on regular meetings. That Kamil, why do you invest a lot into life science? And I share with them the pros, and I don't see any cons because their lease they ask for fair leases like 5-10 years with extensions. They are not Walgreen that asking for 25 with 5 years bumps, 5 of them up to 50 years. They are 5 to 10 years leases, but again, the volume, the investment that the tenant put into the asset, it secures for you that revenue stream that is on an ongoing basis. The proximity to Duke University and other universities is definitely an advantage because I don't only do business with them, I also do deals with the universities on patents. And I am known for this in the market, that I negotiate patents on the medical fields and also on the fintech side.
Fantastic. So Ken, let me come back to you. Recently there was a buyout in the self-storage area. Extra Space acquired a competitor, Life Storage, for $12.7 billion. So one storage company buying another for $12.7 billion. Talk to us as if, a family office is thinking about investing in, self-storage. What should they be thinking about that acquisition? What does that say about self-storage?
Well, it says we're no longer a stepchild as an investment asset category, for sure. What we've seen in the last 3 years is a number of multi-billion-dollar acquisition deals. Public Storage has bought 4 large private firms, all over $1 billion. Storage Mart bought Manhattan Mini for $3.3 billion, which was only 17 stores, but they were in Manhattan and they were irreplaceable and had been in the family, the Gottesman family, for 40 years. The bigger firms, the REITs, are trying to grow, and the industry is very stratified. You've got the 5 REITs at the top and U-Haul, which isn't a REIT. Then you've got about 20 or 40 private firms of any size like mine. Then you got a whole bunch of mom and pops that own 1 or 2 or 3. And most of those are in secondary and tertiary and rural markets. The REITs don't want those because you can't manage them effectively. If you got one out in the middle of my favorite city, Nose Pick, Arkansas, if there isn't such a city, there should be. So apologies to anybody from Arkansas in the room. So what they've done is they're starting to cannibalize each other. So what Public Storage did is they made an unsolicited offer of $11 billion for Life Storage. Life turned them down, and Extra Space came in and offered 12.7. And Life said, "We surrender, it's yours." I think the the third largest REIT, which is CubeSmart. And if I were Chris Marr, their CEO, who's an old longtime friend of mine, if I were Chris, I'd be a little nervous right now. I'd be checking out my retirement options because Public Storage has the money behind them and they have a huge investment from Elliott Management out of New York. And they took 2 board seats and they said, we want to grow. So my guess, if I were a betting man, I guess I am since we got 18 projects under development, is that sometime in the next 12 months, Public will make a run at CubeSmart. If I were a family office, there's, you can't go just buy one.
Right.
And I didn't mention earlier that we don't own any facilities. We're a management company. We own
Repeat
pieces
that,
of them, but
Ken.
we don't own them
That's
outright.
such an important point. Repeat that again to everybody, that you don't own
Yeah,
facilities.
we don't
You're the
own those
management
103
business.
stores or the 18 under construction. We own 3, 5, 10%. And our clients are huge, big institutions. We've managed money for the state of Michigan retirement system, the General Mills Pension Trust, Harvard's endowment fund. Our biggest account like that now is the retirement plan for the state of Texas, which we have 5 assets with. And we have a number of high net worth family offices because, again, there's so many tiny little moving parts. If you own a 100,000 square foot industrial building, you got 5 tenants on 10-year leases that send you a check every month. And all you have to do is the owners make sure the janitor shows up and the landscaping guy shows up. If you have a 100,000 square foot storage facility, you got 1,000 units. If you're full, you've got 900 tenants and they turn over 75% a year. There's lots and lots and lots of moving parts and they just aren't set up to run it. So you've got to pick a partner or you will get run over by a herd of ants. So that's been our business model for 30 years, working with high net worth families and our offices and with big institutions who want to get in the business and can't do it on their own. I want to take questions here. Matthew?
Oh, yeah. If you have a question, go right ahead.
Yeah, so I have a friend that's invested, I guess, millions and millions of dollars. And back in 2021 during the pandemic.
We can't hear you.
Oh, is there a microphone here? I can't get out of here. I don't know if it's on or not. We'll find out. Is there a button on there? There you go. Sorry about that.
So I have a friend here and he's up over in Jackson Street and back in 2021, he said, I guess he has tons of these. Maybe he's vested in you, a guy called Lyle Payne.
I've known Lyle for about. He passed away this year.
Yeah. But he said, I'm selling a whole bunch of those. He says, because the PE or whatever ratio he used was so good because the guys who are buying it thought that they could always finance forever at 0% interest. So I guess he disposed of most of them.
I really don't know.
Yeah, but the idea was that there's got to be a time when there's low interest rates and people. So when you say 95% in good times, 110% in bad times, is for him at least. Maybe he sold to a bunch of amateurs and he got a lot more money.
Interest rate was the driver in the last 3 years.
Yeah.
The driver was there were so many new funds formed that went out and raised 3, 4, 500 million, $1 billion with the single purpose of investing in storage and had to spend the money. So prices were.
Okay, so that's what happened. Okay.
We sold some in that period of time too at prices I couldn't believe. It's what I call the surrender theory of real estate.
Yeah.
You give me enough money,
And it's hard to hear you with the other microphone on. Please turn off that other microphone, you in the audience.
a red light on that thing somewhere.
Oh, yeah. Okay.
There's another question in the back, Matthew.
Yeah, that's great.
How would you see the DST's entry in self-storage as well? I did a lot of trade deals and we put some people in public storage through the DST process
And the
for ownership.
The biggest provider of DSC real estate in the country, to my knowledge, is a firm called Inland Private Capital out of
Right.
Chicago.
Correct.
And we have about 80 of our 120 properties within them, and about 70 of those are.
Please turn off that remote mic. We can't hear Ken.
So we've done a lot of DST stuff. What was the bill? I forget now. The last couple of years, there was I think in the real estate market, I can't remember the code name for it, but where if you bought something and invested another 50% plus a buck, you got some humongous QOZ, qualified opportunity zones.
Yep.
That bill.
Hey, Marty, please turn off that remote mic. We can't hear Ken.
It's off.
Thank you.
Is mine on?
I think mine died, Matt, it's me.
Yeah, we've got a lot of background noise. So let me switch over to Camille. Camille, I have a question for you. I know you and I, because of my position at Pace Equity, we care so much about the environment. We care so much about ESG. With the way that we finance our capital stack at Pace Equity, energy efficiency and carbon capture is what we do with our engineers at our firm. I know that you care so much about ESG and greenwashing. Talk to me a little bit about what greenwashing is. Talk to me a little bit about, your, interest in ESG and why family offices should be, interested in that asset class or space as well.
Again, excuse me, investing in renewable energy is conscientious. At the end of the day, it can be regulated with regulation and with disclosures, but it is a self-driven, conscientious investment. And the family offices are in position to different from what corporate is all about. Investing into the food we eat, the air we breathe, the water we drink is very essential and very important for the families. Greenwashing is in simple words, is claiming what you do not do. The big corporations, small, medium-sized corporations, they write checks for that they are investing in ESG, but at the same time, when you take a deep dive into their operating due diligence of their operations or those operations of their portfolio companies, you find that it is not true. So it is just to make the headline, but in practicality, it is not being practiced. That's what greenwashing is all about. And that's why you see the European passing their legislation of the SFDR and the CSDR, and then now the SEC is going to follow suit to demanding not only regulation but also disclosure. You said that you invest with Ken in Devon self-storage, right? So you just did your due diligence over the phone. You ask him how many women they have versus how many men. You ask him if they have, they produce electricity for those lighting in their aisles and in their facilities through propane generators or through solar or a combination. The tilt-up concrete that they use, does it have any ESG code, or it is emitting carbon dioxide to the environment? In their climate control assets, regardless if it is fourth or fifth generation, meaning the most modern ones. The type of material, because we know that commercial real estate emit the most amount of carbon dioxide to the environment. And self-storage is no different. The only advantage, self-storage does not have sleeping residents. Self-storage only has visiting. We're
not supposed to have sleeping residents.
Exactly. Visiting residents. So they have maybe less pressure from the regulator. But at the same time, we are very cognizant of every practice of due diligence that we conduct. I get deep into the three letters, into the E, into the S, and into the G when I am involved with a fund manager or when I am doing direct investments on a lot of questions. I mean, I would say the ESG alone has at least 35 questions on my initial second meeting, because in the first meeting, we don't conduct that. In the first meeting, we establish chemistry with the partner. In the second meeting, when I am conducting ODD, ESG is a front and center. And if I find that fund manager or that GP is pushing it aside, I definitely excuse myself politely and professionally, and I do business with someone else.
Well,
Matt, can I just jump in here for a second?
Sure, go ahead.
So Kamil, just real quickly, that the European policy that's being passed, do you think it's actually going to be implemented on a timely basis, or will it be put back, postponed? Number one, and then number two, is it the worst time to try to implement this policy, given that Europe's going into a deep recession?
Let's take them one at a time. Now, the SFDR, the European Union legislation, is in its third anniversary. In the first anniversary, they eliminated 22% of the claiming countries that Matthew labeled them, which is true, that they are greenwashers, because they were making the claim, but they are not, walking the walk. Let's put it this way simply. In the second year, every year, by the way, their anniversary is on March 10 of every year. This March 10 of last year, they decided that due to the, again, similar percentage that has to be ejected out of the system, the legislation had added a new chapter. When they started, they had two chapters. One is called Chapter 6, one Chapter 9. When you are in Chapter 9, you are committed to ESG. When you are in Chapter 6, you are freehand. And definitely many people were afraid of the freehand because that discourages the youngsters, the people who are conscientious, and also new capital. So they created a third chapter that they called it Chapter 8, where Chapter 8 is less regulated and you can have a mix, providing that the ESG mix is a heavier weight in it. That's on the legislation. On the second part of your question, look, when times are tough, you look for yourself first. You go back to what Milton Friedman demanded in the 70s, that you as a fund manager or a GP, you provide return of investment to your investors and let your investors exercise their prerogative on where they want to place their philanthropy or the good deed. So today there is less capital going into ESG, we know that. And on the other hand, the other uphill is more regulation. I always say that I myself, I'm always afraid of over-regulating, because over-regulating in most cases discourages many investors from entering the field. I hope that.
Well, my answer is that I think Europe's going to go through some interesting times in the next couple of years, and this kind of a self-immolation with Germany and what's gone on with Russia. So not a good situation.
I agree with you.
But I have a question for Ken. So Ken, self-storage. Number one question is it a smile economy sort of geography, or is it anywhere in the US? It's a great place to invest, number one. And number two, Miami has become the most expensive city in the country now versus the average income of people in Dade County, Florida. Is it better to own self-storage in Miami or to own an apartment?
We don't own anything in Miami, and we certainly don't own any apartments there, so I can't answer your question very factually. We are a bottom-up developer, not a top-down. We don't say we have to be in a given market and then go find something. We look for an opportunity first. Most of our properties are what we call conversions. We look for vacant buildings, primarily retail. My favorite company in the whole world is Kmart. Every time you think you found the last dead one, you find 5 more. We buy them very cheap, and we convert them to state-of-the-art facilities. And what we look at is the radius of 3 miles from that location, because 90% of your tenants will come from within 3 miles. They won't drive more than about 15 minutes or 3 miles, because in most markets, you'll pass a couple. And we don't have a brand name. Public Storage is the closest, but that's only in a couple of markets. We don't have a Rolex or a Mercedes or Coca-Cola. So it just, our signs say self-storage in big words and Devon in little tiny words. Nobody cares about Devon except my 2 daughters and my granddaughter, because they like the paychecks. So we look for markets where we call saturation is very low. In other words, what the level of competition is versus the number of people in that market. It's a number that we get. You take the square footage divided by the people. National average is there's 8.5 square feet of self-storage for every man, woman, and child in America. And, in Las Vegas, it's 35 square feet, so you're never going to get a rent increase because everybody competes by dropping price. And in Manhattan, it's a 1/4 square foot per person because there's a ton of people and you can't get any land to build anything. So we look for low, what we call saturation ratios. And right now, of the 18 under construction, 7 of them are in Wisconsin and Michigan, which wouldn't be intuitive.
They're not.
Part of the small economy, right?
And they're doing very well.
Are those near like education centers or?
Well, we have one in Eau Claire, which is next to Madison, which is the university there. Students are great because every May, they all leave their dorms, apartments, fraternities, sororities, and move in. So you look a hell of a lot smarter than you really are as far as occupancy. And every August, they move back out again, and you look dumber than you really are. So we don't depend on students for our tenancy. We have one in, where's University of Georgia? In Macon?
Yes.
Athens. We have one in Athens. And, we have a lot of them by universities. The thing I don't like is putting one near a military base so that you can take advantage of the sailors and soldiers who get stationed in, wherever around the world. So we do very, very little of that. But most of our things are conversions. We buy vacant buildings cheap from distressed sellers where the city is finally willing to change a zoning or a building permit because they're tired of the eyesore, the graffiti, the broken glass, the raves, the homeless camps, the meth labs, and finally, figure out maybe we're better than what they had. And that's our game plan. We try to find homes.
Maybe it's the frown economy, not the smile
Let me ask you
economy.
a question that I think, people want to hear about, which is,
Sure.
technology. So Camille, this question will also apply to you. So Ken, let me start with you. Ken, I know that, Devon Storage has started a software business, right? A secure platform where you and other storage companies get together and, you feel like you're a disruptor and you feel like you're competitive against, Amazon. Talk a little bit about why AI, why real estate technology, cloud computing, process automation has become so important to self-storage.
Well, we're a pretty pedestrian business. I mean, we're renting little metal garages, 3 metal walls and a wire mesh top and a roll-up metal door and no utilities. So one can get carried away with technology. What we did starting in 2006 is we started our own captive reinsurance company in the Cayman Islands for tenant insurance. And in 2016, we started a U.S. agency to help us market it. We've started a catastrophic reinsurance company in the Caymans. In 2006, we did 600,000 of premium. And in 2022, we did about 130 million. And it's hugely profitable. We started to run the stores, you have what's called a PMS or a property management system. 20 years ago, there were 20 of them out there, independent companies. Today, there's probably 5. There's been a lot of consolidation. So we went and there are 26 member firms in our little cabal here that did all this, of which I'm the CEO. And so we started a company to do the property management software as well. And we opened that up in December and it's going very, very well. And the bottom line is we just said that we had to own our own technology stack because we didn't want to wake up one morning and find out that all of our technology was now owned by that little bookseller up in Seattle, some of you may have heard of, called Amazon. And the only asset we have are our tenants, not the buildings. Buildings are worthless if there's no tenants in them. And we don't want to have any ability of anybody, if at all possible, to get between us and our tenants and try to sell something different or extra or whatever. And so this group of 26 of the biggest non-public self-storage companies in the country are, driven to own our own technology stack. And there'll be some more additions to that over the next couple of years, but we can only do so much in our spare time. At the end of the day, I still got to run a self-storage business with a lot of assets.
Is there a future value of self-storage assets? I mean, do they often get converted later on into
something else?
Yeah.
To the best of my knowledge, there's only been 1 or 2 that have ever been changed from storage to something else. And they've usually been eminent domain where the city wanted to build a freeway. It works the other way. We go after the other assets. They rarely have ever come after us.
Camille, let me take the question back to you in technology. Talk a
Matt,
little
this
bit
is the
about.
last question.
That's fine. Talk a little bit about, real estate technology, cloud computing, process automation, data analytics. Talk to the family offices and tell them why this has become so important and strategic when looking at whether family office or self-storage or industrial or, cold storage, why tech is such an important part of your due diligence.
Due to the fact that we are absentee owners and strictly LP. Take, for example, if I am investing with Ken, right? And I am overseas, when during our initial meetings and at the time we execute a contract, Ken and I demand access to a data room. That's your first technology. I asked Ken, how do you maintain your annual operating management? You know, what is the software management that you use? How do you know how much money you put in the bank, how many people moved in, how many moved out, how many units you have regular storage, and how many of them are climate control storage, because they are two different pricing within the same unit. And at the same time, you know, today, if it is self-storage that we're talking about today, or every other asset, I need to have access to the data room, because that's how my accounting team can, on regular basis, due to the fact that we are in a time zone 8 or 9 or 10 hours ahead of the United States, we need to have access when you are asleep. So we cannot establish communication only during our daytime, because we don't have the same time. So having the management software, having the access to the data room, having the access to the cyber security to make sure that all the information is protected. I'm not big on cloud, because I'm also, there is a lot of personal data that it is private to those 400, 500, 800 tenants of the self-storage or the building, that some people do not like to have their information on the cloud. I am not for owning the technology, because technology is in constant evolvement. So if you have your own technology, you must maintain the team of the coders that they did it for you. Every time you want to add a new addition to it, that can become very expensive, and that will limit the knowledge and the exposure to the market. I like to work with national companies that provide a software, and that constantly they are subscribing me to the updates. So we are always on top of the state of the art of whatever is needed in that to manage that particular asset, if it is a company or it is a commercial real estate.
Right. I think
Matt, can I
family offices.
I just want to ask a question of Kamil.
Sure.
Camille, listen, this is a great
Who's that,
statement.
Marty?
Yeah, it's Marty. Yeah.
Okay,
You know,
okay.
the data that's involved these days in real estate, and actually, I mean, we've seen so many innovative prop tech companies where they do all kinds of inspections on a regular basis using, you know, so you can rent a guy who wears like some kind of a weird camera harness, and he'll walk around and do inspections for you. It goes into a database, and then AI can run all over the information in that database, right? So, I mean, I would imagine that stuff like visual data is really important for a guy where you're in Dubai and you really want to understand the assets that you have ownership of, right? So
We do. I mean, take for example, there are several assets we own that we use Yardi, for example. But I do have also companies that also do inspection over Yardi, to come back to me and say, Kamil, but the market has new features provided by XYZ company that Yardi does not have. So in my communication with the Yardi guys that are in charge of my account, I raise with them the issue. If they tell me that if they push it aside, that means they don't want to spend money on it. And if they tell me that we are working on it and it's going to be added as a module to what you are using in the next few weeks or a month, I'm fine. But if they say to me, oh, it is something we will look for in the future, that will make me change my mind. So,
yeah,
but
I'm just
I
thinking
like
about
to
even
always,
from a compliance point of view, like, you know, there are unscrupulous operators who aren't Ken, but who might be in the same business. And if you have, you know, assets that have become unusable because of water damage, whatever, smoke damage, air conditioners broke down, you want to be able to see proof that stuff is still being used, no fraud is going on, et cetera, et cetera. And that just seems to be, it would become routine over time.
it will be. It will be. And definitely you take it on a case by case and a state by state, by the way, due to availability of coders and also of markets that are covered by new innovations. But there is nothing in absolute, and I cannot generalize when I say we'll use the same property management on everything, on every asset that we own, because we own different types of commercial real estate. So one software might apply for one operation, but will be limited in the other operation. So just like the preceding panel, when they were talking about assets and also on the use of telemedicine and also all the related topics that they covered, those software, they applicable to the assets that they are interested in. So for our assets, I like to have always a free hand and an open mind to constantly have a door open for other innovators to step in and say, Kamil, I have added the following. Just like when we talk about CoStar or about Reonomy or about LoopNet, we make choices. And sometimes we change our mind or we flip. But I always give my current provider the benefit of matching or even exceeding. But all your points are definitely valid, Marty, and for what Matthew is alluding to.
And we give access to our capital partners, to our software system, but only for their stores. And they have 24/7, 365 access. And
Beautiful.
the software does everything on that site and every permutation and combination of what could happen there. And they can spend their heart's content looking at it.
How granular can your software become? There's a guy who is building out communities, and he approached one of the developers of the software so that he can have different LPs owning different shares of communities, and they can actually go in there and really.
Ours is pretty specific to self-storage.
Got it. Uh-huh.
It wouldn't work for, say, an apartment house guy.
Yeah. And typically you have one other owner of the property. You're going in for 5%.
All of our properties are in separate accounts. There's one capital partner and us.
Yep.
We don't do funds or commingle everything. Been down that road. I don't want to have 30,000 people to write quarterly reports to.
Yeah, we didn't get, Matt, we did not get into the capital stack at all of any of these real estate assets, which of course is always a big deal in any investment or
Sure.
fund space, because people want to know who they're in a deal with, right? So anyway, this is a great
Thank
job,
you.
Matt.
Thank you
Yeah.
very much, Kamil. Thank you very much, Ken. Marty, thank you. And K&L Gates, thank you very much.
Thank you.
Yeah, we're really lucky to have such great speakers, and we've known Ken for many years, and actually he's kind of a little bit of a legend in New York for people that know him. And Kamil obviously is a global sort of figure. So we're going to move on to the next panel, which is on real estate as well. We're going to have Matthew Bishop come up. Is Ken Ketchke's here, or is he online? Oh,
Ketchke's.
fantastic, great. And then we've got Deborah Chan. Deborah.
No, Deborah won't be joining us. Deborah had a medical issue. She won't be joining us today.
Oh, okay, great. So we'll have we'll go for about 40 minutes.
That'd be great.
Matt, I'll leave up to you. And
Terrific.
we'll go from there.
Thank you very much. Is Ken Ketchcase in the room?
Yes, he's
Right there.
pulling right in.
There he is.
How we're going to sit next to each other again.
Yeah, it's good to see you.
Hi, Ken. Nice to see you.